G'day Gain Squad, I am so stoked to have you back at Goldie Gains for our midweek market deep dive. Let's see where the smart money is flowing today, because things are moving at a hectic pace in the financial world. We are breaking down the massive price flush in gold that happened on Wednesday, March 18th, 2026. We'll also cover the Reserve Bank of Australia's surprise rate hike and why the Magnificent 7 tech stocks are starting to crack. Plus, we have an update on the oil shock from the war and how the TATA trade is playing out for the dollar. Just a quick disclaimer, before we optimize this entry, I'm not a financial advisor, so always check your own data. The big question for today, gold getters, is whether this massive dip is a trap or a proper golden entry for your portfolio. Is the 4-week low we just hit a signal of a deeper crash, or are the central banks about to step in and save us? Drop a comment below with your price target for next week and hit that like button to support the squad. If you're new here, subscribe and join the Smart Money community as we navigate this wild 2026 cycle together. Breaking news first. Operation Epic Fury has entered its 3rd week and the Middle East is absolutely popping off right now. The US and Israel have intensified strikes against Iranian missile sites, carrying out over 7,800 missions so far. On Wednesday, March 18th, reports came through that several Iranian leadership targets were hit in a massive wave of operations. The Strait of Hormuz is effectively closed to Western vessels, which is creating a proper mess for global supply chains. President Trump is reportedly considering sending thousands of reinforcements to ensure the regime cannot project any more power in the region. The United Arab Emirates and Saudi Arabia are intercepting dozens of drones and missiles daily as the conflict spills over borders. It is a proper shock to the system, and the uncertainty is keeping every single trader on the edge of their seat. Iran is reportedly using their geographic trump card to harass tankers, which has basically cut off 20% of seaborne oil. We are seeing a historic military escalation that is forcing central banks to rethink their entire strategy for the rest of the year. This is the 3rd major economic shock we've faced recently, and it's showing no signs of slowing down before the weekend. Let's talk about the black gold, because WTI Crude oil is experiencing a massive amount of stress and volatility. On Wednesday, March 18th, the US benchmark was trading around $94 a barrel, but that doesn't tell the full story. The Oil Volatility Index, or the OVX, hit a massive reading of 121, which is total panic territory. We are seeing what we call pronounced backwardation, where people are paying a huge premium for oil right this second. Diesel and jet fuel are in acute shortage, because the Middle East refining hubs are struggling to get their products out. US diesel prices have already blown past $5 a gallon, which is going to be a massive headache for local inflation. The International Energy Agency is releasing 400 million barrels from reserves, but the market reckons it's not enough. Asian crude benchmarks like Dubai are trading near $160 because they are closer to the physical supply. It's a fragmented market right now, mate, and the high energy prices are acting like a lead weight on the global economy. Smart money knows that as long as oil stays high, the Fed will have to keep interest rates higher for much longer. Closer to home, the Reserve Bank of Australia gave us a proper surprise on Tuesday, March 17th, 2026. The RBA board voted to hike the official cash rate by 25 basis points, bringing us to 4.10%. It was a razor-thin 5-4 split vote, which means our central bankers are seriously divided on the next move. This is our first back-to-back hike in years, and it shows the RBA is terrified of the energy-driven inflation spike. The market only had an 80% chance of a hike priced in, so the decision caught a few traders off guard. Governor Bullock is trying to balance a cooling labour market with the fact that petrol prices are through the roof. The rates market is now thinking we might see another hike in August, rather than the cuts we were all hoping for. It's a tough environment for anyone with a mortgage in Sydney, but it shows the RBA is prioritising the currency's stability. Australia is leading the charge as one of the first major central banks to hike since the Iran war started in February. We need to watch the upcoming employment data very closely to see if the economy can actually handle these higher borrowing costs. The ASX 200 index has had a bit of a wobbler this week as it tries to digest the rate hike news. On Tuesday, March 17th, the index actually managed a small gain of 0.36% to close at 8,614. But on Wednesday, March 18th, we saw a bit of a rebound as it climbed 0.31% to 8,640. The big banks like Westpac and NAB were the main winners, gaining about 1% because higher rates help their margins. But the local tech sector got absolutely hammered, with Zip dropping nearly 6% and Block sliding about 2%. Real estate stocks like Vicinity Centres found some relief as the market hoped the RBA wouldn't get too aggressive from here. Materials were a mixed bag, with BHP and Rio Tinto seeing small gains as iron ore futures in Asia found a floor. Gold miners like Northern Star and Evolution Mining are having a hectic time, with Northern Star down nearly 20% this week. It's a weird one, gold getters, because you'd expect miners to soar during a war, but they're getting caught in a liquidity flush. Keep an eye on that 8,777 level for the ASX, because we need to reclaim it for a bull run. On the currency front, the Aussie dollar pair has been testing the 0.7090 level this week. Our dollar got a bit of a boost from the RBA hike, but it's struggling against a US dollar that is staying super strong. The DXY is hovering just under the 100 mark as investors flock to the greenback as the ultimate safe haven. Every time our Aussie dollar tries to rally, the surging oil prices and inflation fears send the US dollar back on top. Smart money is watching for a breakout above 0.7100, but we need the US dollar to take a breather first. The currency markets are reflecting a massive tug-of-war between our local interest rates and the global energy crisis. Traders should be cautious here, because a hawkish Fed meeting could send the Aussie dollar back towards 0.70. The market's having a bit of a wobbler with the Aussie dollar pair as we wait for more clarity from Washington and Tehran. If you are trading Forex, keep your stops tight, because the geopolitical headlines can cause a 50-pip swing in seconds. Our dollar is effectively a pro-cyclical asset, and right now the cycle is looking a bit messy due to the war risks. Now let's look at the Magnificent Seven tech giants, because their dominance is showing some serious signs of cracking in 2026. For the first time since 2022, the majority of these tech titans are actually doing worse than the broader SP 500. Amazon and Microsoft have had a rough start to the month, down over 7% and 15% respectively so far. Meta Platforms is the only one really monetizing AI, right now, trading at about 21 times its forward earnings. Tesla is a total avoid for many right now, mate, with its valuation still sitting at nearly 200 times its profits. Investors are starting to question if the massive spending on AI data centers is actually going to deliver the promised returns. We are seeing a shift away from high multiple growth stocks and into more stable consumer staples and dividend-paying companies. The cohesive narrative that kept these 7 stocks together for years is fragmenting as their business models start to diverge. This is a massive regime change for the equity markets, and it could be the catalyst that finally pushes capital into gold. When the big tech trade dies, the smart money always looks for the next major trend, and hard assets are looking juicy. Have you heard of the TACO trade? It stands for Trump Always Chickens Out, and it's making a massive comeback this week. Last year, every time Trump threatened a tariff, the market sold off, and then he backed off and the market rallied. But in 2026, some traders are calling it the TATA trade, meaning Trump always tries again with these sanctions. As soon as WTI Crude hit $119, Trump declared the war was very complete to calm the markets. Oil immediately plunged back to $85 as investors breathed a sigh of relief, which is a classic taco move. But the situation in Iran is far from over, and the market is learning that Trump's bluster is actually backed by kinetic action. The taco trade worked when it was just about trade wars, but it's a lot riskier when there are actual missiles flying in the Gulf. Smart money isn't betting on a total de-escalation just yet, which is why we are seeing such massive volatility in the energy sector. If the TACO narrative fails, we could see oil spike to $200 and the stock market enter a proper freefall. Keep your eyes on the headlines, because one tweet or one missile can flip the TACO trade on its head in an instant. We have to talk about de-dollarization, because a seismic shift is happening in the global financial architecture right under our noses. For the first time in modern history, global official gold holdings are effectively at parity with foreign holdings of US Treasuries. That means central banks are holding as much gold as they are US debt, which is a total end-of-an-era moment. On Monday, March 16th, news broke that Iran allowed a tanker called the Karachi to pass through Hormuz using Yuan payments. If Pakistan and Iran are settling oil in Chinese yuan instead of US dollars, the petrodollar system is in serious trouble, mate. China has been on a 16-month gold buying streak, adding hundreds of tons to their reserves to bypass the Western system. India and Russia are doing the same, creating a multi-currency energy trading system that doesn't need the US dollar for clearing. This is a structural shift that creates a permanent floor under the gold price because central banks are now price-insensitive buyers. When they buy gold, they aren't looking for a quick flip. They are looking for protection against the weaponization of the dollar. Every tanker that settles in yuan is another brick out of the wall of dollar dominance, and that is fundamentally bullish for gold. So let's get to the gold price action, because Wednesday, March 18th, was a total bloodbath for the paper markets. Spot gold flushed down to $4,816.39, hitting its lowest level in 4 weeks. It was a proper not happy Jan moment for anyone long on leverage, as the metal dropped over $190 in a day. This happened because institutional traders needed to raise cash fast to cover losses and margin calls in the tech and energy sectors. Gold is the most liquid asset on the planet, so it's often the first thing people sell when they're in a bit of a pickle. But here's the interesting part. While the paper price crashed, physical gold premiums stayed incredibly high for coins and bars. On Tuesday, March 17th, gold was still hovering above $5,000, closing at $5,008.20. The breakdown on Wednesday was purely momentum-driven, as we breached the key 50-day moving average and triggered the bots. Since the start of 2026, gold is still up about 15%, so we have to keep things in perspective. Gold getters. This flush is a classic shake out the weak hands move that we see in every major bull market before the next leg up. JP Morgan and UBS are still keeping their price targets above $6,000 for the end of the year, so don't panic. The structural reasons for owning gold war, debt, and de-dollarization haven't changed just because the paper price had a bad day. The market's having a bit of a wobbler, but for the long-term smart money, this is just a reset of the overbought levels. We are seeing a massive decoupling between the physical metal and the paper contracts traded on the exchanges in New York. Remember, this is a proper golden entry if you believe the fundamental story is still intact despite the short-term noise. Now for the technicals. The daily relative strength index for gold is currently sitting at 20.7, which is extremely oversold. We've broken below the 50-day simple moving average at $4,978, which is now resistance. The 200-day average is way down at $4,126, so we still have a huge buffer. Bollinger Bands are starting to narrow on the 4-hour chart, which usually means a massive move is coiling up and ready to explode. The MACD indicator is currently in a sell signal at minus 42.59, showing the bears have the momentum for now. We are looking at a critical pivot point at $4,852 that we need to reclaim quickly. Support levels are sitting at $4,811, which is where the buyers might step back in. If we can't hold that, the next major structural floor is all the way down at $4,600. Overall, the technicals are screaming that the market is stretched to the downside, and a relief rally is probably just around the corner. To summarize the big points, Operation Epic Fury is raging on, and the Strait of Hormuz remains a massive choke point for global oil. The RBA hiked our rates to 4.10%, causing some serious pain for tech stocks on the ASX Index. Magnificent 7 tech giants like Amazon and Microsoft are bleeding, forcing a rotation into safer, dividend-paying assets. De-dollarization is no longer a theory, as Iran and Pakistan start settling oil trades in Chinese yuan to bypass US sanctions. Gold had a massive flush on Wednesday, hitting a 4-week low of $4,816 due to paper liquidations. Despite the dip, the long-term bull case is supported by record central bank buying and a global shift toward hard reserve assets. We are currently in a corrective phase that is resetting the greedy sentiment we saw back in January when we hit the highs. Now, back to our big question. Is this the ultimate bottom, or do you reckon we have more room to fall before the next moon mission? Let me know your thoughts in the comments below, and don't forget to like and subscribe to the Goldie Gains channel. We will be back on Friday with a full wrap of the week and a look at the latest from the US Federal Reserve. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!